Hello, and welcome to today's webinar. For those of you who do not know me, my name is Joe Salvatore. I am part of the CCM team here. I'm also the youngest in the office, so by default, I am the Zoom operator. For those of you who joined us last week and are coming back, we thank you and welcome back. If this is your first time attending our webinar, welcome, and we hope you enjoy this one and join us for future ones. So speaking of that, this is a webinar series. So this is our second of 4 that we currently have scheduled. We do plan on scheduling more. If you like what you see, you'll want to come to the next few ones. Just look out in your email. We will be sending out emails on Thursdays to register for the webinars the following week. So keep an eye out for those. 2 other things to note before I hand things off to Randy. One is going to be the question and answers. So if you highlight your mouse over the video itself, you're going to have a little control panel. At the bottom, you will see a Q&A box. So at any time throughout the webinar, if you do have any questions, you can type them in there. The way that we're going to do it is once I hand it over to Randy, he's going to go through the whole presentation, and then at the end, I will come back on and ask any of the questions that were put in there throughout the presentation, and Randy will answer those. The other thing of note, you will see a little notification at the top that says this is recording. So we are recording this for the people who were not able to attend or anyone who wants to go back and watch this. All of this is private. No one can see any questions that you ask. No one can see the attendance list besides myself and Randy. So everything is private. Don't have to worry about that. And that is it. Once again, thank you all for attending. I will now hand things over to Randy, and I will come back at the end.
Hello, everyone. Welcome again. It was great having this type of webinar started last week. Some of you were there last week, and I want to thank you, and I want to thank you for coming back. And we want to spend next 30 minutes or so going over one of the 4 areas that we wanted to cover. So last week we talked about the required minimum distribution and how that would affect you. Today we're going to be talking about something that's important for most of us, is our actual retirement plans. But to get started, just to let you know that even though I have a lot of accounting background, I am not an accountant. I don't give a tax advice. So we do have CPA who offers that. And I am not an attorney, even though a lot of times I read a lot of legal papers, because a lot of our clients have issues or questions about that. So we recommend people to see an attorney when it comes to the legal matters. Anyway, to get going today, when I was putting this thing together, you notice the picture that you see on the screen. Most of us are not only stuck at this weather. Weather is not great. I guess it's not bad, but it was drizzling earlier. But I would like to be, I'm sure some of you agree, I like to be at the beach or someplace it's warmer. So let's hope that that will happen soon enough. So what we want to talk about today is some of types of programs in retirement. Mainly, they are considered qualified plans: 401ks, 403bs, 457s, IRAs. Sometimes if you work for a police department or fire department, you may have a drop money. And then there are some non-qualified deferred comms. So there are other types of programs, but we're going to talk mainly about these 4. Sometimes when I mention 401k, think of that as I'm also mentioning about 403bs and other qualified plans. They pretty much work the same way. If there's anything differently, then I will explain to you what they are. So let's go into this. Recently, the CARES Act went in at the middle of March. I think as our stock market was hitting the bottom, this CARES Act went in. Basically, what it does is it makes it easier to withdraw funds from your certain tax advantage retirement accounts, like 401ks and traditional IRAs, and of course 403bs and TSPs as well. These are temporary changes which eliminates tax penalties on certain withdrawals, and they have a relaxed rules on loans you could take from these type of accounts. They have restrictions, however, with the CARES Act. Not all tax advantage retirement accounts holders can take advantage of the CARES Act for taking an early distribution or taking a loan against it. Specifically, there's a legislation tells you what you have to do to qualify for that. And some of those qualifications are, you have to be diagnosed as a COVID-19 patient, or you have a spouse or a dependent who's diagnosed with that. Or if you're experiencing a layoff, furlough, or reduction in the hours that you work, then you are able to take these advantages. So CARES Act allows you, if you qualify, to take advantage of the retirement plans by not paying certain taxes or penalties. You can take any from your retirement plans, whether it's an IRA or 401ks, you could take up to $100,000 out of your account, even if you're now 59 and a half, and not pay the 10% excise penalty. Of course, you have to pay taxes on it. Any amount of money that you take out, whether you're prior to your 59th birthday or after, any money comes out of your qualified account, you got to pay taxes. So just realize that if you need the money, you are able to take it out. And if you're a younger person who needs the money, you don't need to worry about paying the 10% penalty. In addition to that, CARES Act allow you to not withhold any taxes up front. Typically, in typical 401ks, if you were to withdraw money, your account had to be withholding 20% of the value of the money that you're taking out and send that to the IRS. You don't have to do that this time. At this current time, you're able to take out the money without the penalty and have the whole amount come to you, and then you could deal with taxes later on. So just remember always, you still have to pay taxes. Let's also talk about, in addition to being able to withdraw money from your 401k, you're able to also take a loan against it. The loan, because of the act, you're able to take out $50,000, maximum of 50, or up to 50%, whichever is less, you're able to take the loan against your 401k. Why is that important, or why would you want to borrow against your 401k rather than withdrawing it? First of all, when you take the money out as a loan, you don't pay taxes. So that would be the main reason why you may want to do that. And when you pay the interest and principal back, then essentially you're paying yourself with the interest. So that has a lot of benefits versus the withdrawal where you have to pay taxes and you would never see that money again. For 2020, as I mentioned last week, CARES Act also allow people to not have the required minimum distribution sent to them. So if you don't need the money in 2020, you could ask your custodians, if they are automatically set up to send you the money, tell them to stop sending it to you. Some of the custodians will do that automatically. However, it's better to check to see whether your custodian who holds your IRA account will be either sending you the money because it's set up automatically, or that you have to do it manually by calling them or writing them a letter. So anyone who doesn't need any money coming out of their IRAs or traditional IRAs to 401ks, you don't need to take the required minimum distribution. In addition to that, anybody who were born prior to July 1st, 1949, your required minimum distribution was set up at 70 and a half, which means you still have to take that, except for this year. But starting now, anybody's date of birth after the July 1st, 1949, your required minimum distribution will start at the age of 72, not 70 and a half. So for those of you who doesn't need or want the money, and you were 70 and a half now, you could wait till you're 72. So that also will help you with taxes. In addition to retirees, you should also realize if you're a non-spousal heir for the inherited tax deferred accounts, you were supposed to take the RMDs. You were also allowed to not take it in 2022. Let's talk about what's going on now. Stock market certainly has been very volatile until the month of April. February and March was a very bad time. A lot of you were very concerned, not only because of coronavirus, but you were very concerned about the stock market because a lot of your 401ks, IRAs, and investments were going down. Some of your account may have gone down as much as 40%. I have seen some of the people who have brought in their statements from their 401ks, 403bs, they have gone down as much as 50%. Obviously, since that time, the market has rebounded back. A lot of you have rebounded so that your account is only down anywhere from 10 to 25%, not 40 or 50. So at this time, I get asked a lot about what to do with your 401k. Should you contribute more or less, or just put everything to cash, or should you keep on adding money to your account? Well, I want to share some of my thoughts with you, and my thoughts and my ideas may or may not help you, but if it does, and if you have any questions or concerns about what I say, please reach out to me so we could talk about this. At this time, I always tell people when the market's down, it's best time to buy, which means that if you feel the market has hit the bottom, it's going to continue to go up from this point on, then it may be a time that you want to put more money in. I personally think the market has at least one more time it's going to go down. It may go down as much as 15 to 20%. So if we were still down 20% from beginning of the year, you're looking at a total of 40% or more. So I don't know how you feel about that. Most people are scared, especially if you have retired or thinking about retiring. It may not be a good time to lose money. So what do? Well, one of the things that you can do is, since the market's down, and if you're still working, you may want to increase your contributions. So let's say that you make $50,000 a year. Whether you're single or if you're married, between you and your spouse, if you make double that, 100,000, and market goes down as much as 40%, then your value of your account, if you started out with 100,000 at the beginning of the year, it may be only worth 60,000. It's a lot of money that you have lost. I know it's an unrealized loss, but bottom line is no one likes to see their statement being low or going down. So if it has gone down from 100,000 to 60, and if you're able to put money in it, you're buying it at a lower shares. So I recommend you to do that. Most of us, a lot of people put away between 5 to 6% of their income into a retirement account. So if you're making 50,000, if you and your spouse is making 100,000 and put away 5%, 5% of 100,000 might be $5,000. And if you're single, 5% is only 2,500. But Any money you put away is better than not putting any away. Especially nowadays, a lot of companies are offering to match your contribution anywhere from 3 to 5%. Some more, some less. But if your company matches at 5% and you put away your 5% and you make 50,000, that means you're putting away 10% of the total income you're making. Yours and your company's 10% was $5,000. Again, with your spouse, double that number. What I recommend you to do at this time, if you're able, because you're staying home and you're not spending as much money as you used to, you may want to increase that. I recommend you to increase that as much as you can. Some can increase your withholding up to perhaps 25%. So if you're both combined incomes 100,000 and you're able to put away 25%, then you're putting away 25% of that is $25,000. And your company will match 5,000 on top of that. So now you got 30,000 going in, and buying the shares, they're discounted by at least 40%. So when the market rebounds back, you're going to have a lot more money growing at a faster rate. And that's something that we do. If you invest your money with us to manage, outside of, some of you have annuities, some don't, but we also manage strictly into the stock market. So if we're managing your money, you probably noticed in the last couple of months, we have put anywhere from 15 to 30% of your assets into cash position in anticipation of the market going down further, so we could use that money to buy any assets that's either undervalued or something that we feel that's going to go up faster. So we're looking to do that as well. So if you have any questions about that, how we manage our clients' money, please give us a call or make an appointment with us. So once again, if you're able to put money away, more money into your 401k and 403bs, you should do that as fast as you can. Another thing that I want to talk to you about, second bullet point, whether you should consider paying your bills by utilizing lower interest earning investments. Well, basically that means if you have any cash sitting around, sitting in the bank, even with the 3 or 5 year CDs, any bank CDs are paying somewhere between 1.25 to 1.7%. Interest rate environment is such that for the past 12 years, since 2008, the interest rate has been very low. And I feel that it's going to continue to be that way for a while. So if that's the case, why should you put or keep a lot of money in the bank? I know, like my wife, I know a lot of people like to keep money in the bank for that just in case. You feel much better about having cash laying around than not having it. There are other ways of having an emergency money set aside. Having so much money sitting in the bank also is not a good thing, because you are losing an opportunity to make that money work for you. You certainly can, especially now when the market's down, take the money and invest it in the market, providing that you don't need this money for next 2 or 3 years. I feel very confident, even though there's no guarantees, I feel very confident the stock market will go up drastically within the next 2 years. So it may be a good time to move the money out and either pay high interest paying bills, such as credit cards. Some of you may have a credit card with anywhere from 12, 15, even 20% interest rate. You may want to use that cash to pay that off. You're saving yourself a lot of money. Example of that might be if you had a $20,000 credit card bill. Let's say you got several credit cards that they add up to 20,000, and if you have a 14% interest rate, even if you pay $500 a month, it'll take you 5+ years to pay that back. to me, during that time, all the money you're losing, you're basically giving a lot of money to the bank or credit card companies. And I would recommend you to take the money out of your bank savings to pay that off. If you like to have the emergency money, if you have your house with a high equity built up, you may want to go to your bank and open up an equity line of credit. You don't need to use it, but keep it there just in case. You should use that to replace your emergency money. And I recommend you doing that. Now, let's talk about what you should do in a stock market since all your money or most of your money is tied up in 401ks and 403bs and TSPs. Typically, most of your programs will offer anywhere from 5, 7, or up to 30 different sub-accounts. Mostly they're in the equity market. Some are in bonds, some are in combination. But a lot of people, most people that I run into have more than 50% in the stock market or the equity market. And most of you, as you get older, you've been very conservative. And that's the right way to be. The older you are, more money you should safeguard. And most of our clients do. However, this might be a great opportunity for you to reevaluate your risk and make some decisions of what to do with the money you have. Whether you have your money in the savings account, whether you have your money in some in the stock market, or more money going to your 401k and 403bs, or how about this? What about the money that is tied up in some of your annuities, which has been safeguarded for so long, but because the interest rate environment is such that you're not getting paid at higher rates? Even though any of the annuities that you have, you may not be losing any value of the account, because that's the type of account that we always work with our clients with, that you can never lose the value of what you put in, but it's also not earning a lot of interest. You may want to consider taking a partial withdrawal and use that money in an investment vehicle, which could have a much higher return for a very short time. What I tell people is, why not take this advantage of this slow time or time when the market's down, and let's put in as much money as we can, even if you have to withdraw some of the money out of annuities and roll that into any type of equities that could have a higher potential gains. We could help you with that. We hope that you take advantage of our services. Even at this time, I am in the office virtually every day. Some of my staff comes in here and there, but everyone's working at home remotely all the time. So we're here to serve you. We're here to help you. So if you have any needs or questions or concerns, please call us and make an appointment. Nowadays, I'm doing a lot of appointments through Zoom, like we're doing right now, or by telephone. So take advantage of that. We're here to serve you. Now, a question I have for next is, should you retire early or retire late? Well, that's the decision you got to make. Why would someone want to retire later than now? Well, it could be multiple reasons. One might be that the amount of money that you save to retire, the value of it may have gone down so much that you may need to work a little longer. That could be the case. Sometimes people want to retire early because either you had enough with work, you feel that you deserve to retire, you just don't want to work anymore. Whatever the situation might be, it's an individual decision where we could help you to reach your goal, whatever that might be. Just remember, if you retire early, you got to consider where your health insurance is going to be. Typically, if you have a health insurance through your company or place you work at, if you retire at least till, after 63 and a half, most places will offer the COBRA that you could take with your former company, and if you let it carry that for up to 18 months, which will carry to the age of 65 when the Medicare starts. So that's something to think about. And also you should consider, even if you retire, whether to take the Social Security at that time or later. And we could help you because that's the type of work that we do. We coordinate your investments so that your retirement will be taxed at a very low rate. Some of the things that I talk to you about is I want to help my clients, if their income such, I want to bring their tax income rate down to 12% from 24%. Sometimes you just take a couple $1,000, not by not taking a couple thousand extra, you're able to do that. So we want to help you with taxes if we can. If we want to mitigate any higher taxes you may pay by taking some changes to your account, we're able to do all those things. Now, if you decide to work beyond the age of 70 and a half, the new rule said you could work and also you could contribute your money into an IRA account. You could do that beyond the age of 70 and a half starting now. So even if you're taking the RMDs, if you and your spouse is taking RMDs up to, let's say, 14,000, because you have total retirement account value around 350 to 400,000, that means your RMD is going to be around 14. If you work part-time and earn $7,000 a year, if you have a spouse and your spouse makes 7,000, you make 7,000, that's 14,000. You're able to put all their money into an IRA. So when you do that, you're taking somewhat of a tax deduction. Whereas when you take the RMDs, you got to pay taxes on it. Well, guess what? You're getting extra 14,000, and really you get to put away 14 for the future. So something to think about if you decide to work part-time, because I am planning to do that once I reach that age. I don't have any intention of quitting or retiring full-time. So keep in mind that you have extra way of putting money away when you are beyond the age of 70 and a half for some, 72 for someone who's going to reach that in about a year and a half from now. The last thing I want to talk about is what to do with your RMDs. Since you don't need to take it, should you not take it? Well, it all depends. If you're giving money to a charity and you still plan on doing it in 2020, you may still want to send a letter or continue to have your custodian send the RMD directly to a charity rather than taking it as an income, paying taxes, and then sending the money in after tax to take the deduction. It's a lot easier and better to send the RMD directly to a charity, whatever that amount might be. So with that, I want to bring Joe back, and I know some of you have questions that I want to be able to answer. Joe?
Alrighty, so yes, we do have a few questions here that came in, so I will just go down the list. When do you have to pay back an IRA loan? At what interest, and what interest rate can you charge yourself?
Well, it depends on what your provision of your 401k or 403 says, but you have to pay the loans back by October 15th, 2021.
Okay. Can I still contribute to my IRA for 2019 since the tax deadline has been moved to July 15th?
Answer is yes. Not only your taxes need to be filed by July of this year, but you could also take the deduction of 2019 taxes by putting money into an IRA now all the way through the June 15th.
Okay. My 401k is currently in a mutual fund. Can I change it to either cash or a different fund without a penalty?
Answer can be yes or no. If your 401k or any of your deferred account from your company offers money market account, you're able to do that. Here's where most people have a problem with. A lot of 401ks and 403bs do not offer that. A lot of times when you talk to your advisor about that, they're telling you to put them into an income account, which is a very conservative. Just realize when you have an income account, there are mutual funds, and they are not all bonds. They are not all equities. They're combinations of it. So you could still lose money even in a conservative account. What you might want to do is if you're over age 59 and a half, you can do a in-service withdrawal and take the money out of your 401ks or TSPs and move into an individual IRA and let someone like our company manage that for you. I'm not saying you should close your 401k or 403b. You want to continue to contribute that until you sever ties with your company. But in the meantime, if you're 59 and a half, you're able to roll that out, put them into an account where if we manage it, we could put part of the money or all of the money in a money market account. Obviously, that's for a very short time. If you're not in the market, you're not going to make money. So you want to manage that by talking to an advisor like us.
Okay. The next question, can I pay back the RMD that I have received this year? And can I pay more than the amount of the RMD?
Answer, again, is yes or no. If you have taken the RMD out in month of January, you cannot send that back. So unfortunately, if anybody who have taken the RMD early, you don't have a choice. But if you have taken your RMD in month of February, all the way through even to May, sometime middle of this month, you're able to pay that back or give it back to them so that you're not paying taxes on that. So just remember, if you have taken it before February 1, you don't have a choice. Anybody who has taken it February, March, or April, you're able to do that. And what was the last part of that question, Joe?
The second part says, can I pay more than the amount of the RMD?
You mean, can you pay back more than the RMD amount?
I'm guessing, yeah.
Okay, well, if that's the case, no. RMD is just a required amount based on your age and how much money you have. So if you want to contribute more than that to last year's tax account, 2019, you have to know whether you qualify to put money away in an IRA account. Typically, if you have a pension or a 401k at work, there's a money, how much money you're able to make. There's a limit of what you can make in order to contribute to both. So you could talk to us about that. I could give you the exact numbers based on your situation.
Okay. Is a bond index a good place to keep a large chunk of my 401k so I don't lose my nest egg during this volatile time?
Well, I am not a fan of bonds at this time, where it hasn't been like that since 2008. When the stock market is the way it is, and the interest market the way it is, when an interest rate is low as it's been, and it's continued to be virtually zero, the only way the interest rate will go is one way, that's up. What happens with the bond is when an interest rate goes up, you lose the value of your bonds, which means you're losing money. So you should not have, where I don't recommend having people with a lot of money in bonds, even in this type now. I think some bonds are much more volatile or could lose a lot more money than the equities. So talk to us about your individual situation, that I'll be able to give you a better idea of what you want to do with that bond money.
Okay. And this will be the last question. If there's any other questions that we were not able to get to, we will reach out to you personally. So to finish it off, let me pull it up. Is this the time to pull out money from my annuity and invest it?
Wow, that's a very interesting question and yet very important. Answer is yes. Because even if you don't need the money, the annuities are very good. You virtually cannot lose money, and there's a lot of guarantees to that. However, you don't also make a lot of money when the market's the way it is. So one way of getting it is take out, let's say your anniversary of your annuity is August 1st. I may even recommend for some clients, take 10% out that you're allowed to take out, up to 10% for most of the accounts. 10% out now, roll it into, and 10% after August 1st, after the anniversary. Put that money into an account that you're willing to take some risk with. I'm not saying that you should take money out of the conservative to a risk, but if you got other underlying investments that you're able and willing to take some risk, it may not be a bad idea. Matter of fact, is maybe a good idea to take that money out and roll that into an account that could be a type of account could have a much faster growth. Way the economy has been in the past, when a market goes down drastically, then it rebounds back drastically. So you may want to use that money, put them into an account to have a real good growth. Again, providing you don't need that money for the next 2 to 3 years. By that time, the market will rebound back. And once it, I guess, flatten out or stabilize at that time, and you want to consider safeguarding more, you could put it back to an annuity at that time. Anything else, Joe?
Nope, that is it for now. We can wrap up.
All right. Well, folks, I want to thank you for being with us today. It's always our privilege to spend time with you, spend time explaining what we do. If you have any questions, call us, email us, get to know us if you don't know who we are. We're here to serve you and help you, and I look forward to speaking with you in person very soon. Bye-bye now.